Hello, everyone. Our panel today is on the insider threat. Insider threat is a form of cybercrime in which employees or business associates misuse their access to the systems and to the data in order to perform unauthorized action and gain access to sensitive information and data, both by malicious actor or negligent one. Insider threat is recognized by researchers in the field as well as professionals as a grave hazard. While the scope of these actions or these crimes is relatively low in comparison to other forms of cybercrime, the consequences, the results of this crime is very extensive due to the access those actors already have to the system. Therefore, it's really hard to detect those crimes. It takes more time, and the damage is harsher. Much has been said about technological solutions and training of the employees in this context of insider threat and the way to deal with it and to cope with the problem. But not much have been said or mentioned with regard to cyber insurance and its possible role in dealing with insider threat. Dr. Asaf Lubin is an associate professor of law in Indiana University Mauer School of Law, and he will discuss with us today cyber insurance in this context. Asaf, go ahead.
So thank you so much. I'm delighted to be here. It's a great privilege. So I'll be speaking about the intersectionality between cyber insurance as a risk transfer technique and its relation with insider threats. And what I thought I'll do in my presentation today is divide it into two parts. In the first part, I'll kind of provide a brief overview of what cyber insurance is. And what are its core limitations, and then apply those core limitations in the context of the unique threat model that is insider threat to further highlight where cyber insurance might hit a wall, so to speak. So at the outset, cyber insurance is essentially a risk transfer technique where we transfer our risk to commercial insurers in exchange for a premium that we pay on a monthly or yearly basis. And that model has been with us in its current form for the last 20 years. And it's predominantly strong in the United States. So just to give you a sense, and these are slightly older data from 2017, but the numbers have only increased since there. In the United States, there were 170 US insurers that reported writing cyber insurance of up from 140 million in 2016, sorry, that's up from 140 insurers in 2016 and 119 in 2015. So we're only seeing an increase. In fact, the current numbers speak about somewhere in the upwards of 200 insurers, and they had cyber premiums that hit more than $2 billion in recent years. So we're talking about a massive industry that is only scheduled to increase as more countries outside of the United States are developing cyber insurance markets. The history of cyber insurance begins all the way back in the 1980s with the insertion of computers into our industries. And the first kind of policies that we had at the time are errors and omissions insurance policies that were there predominantly to cover us in the case of various errors associated with the introduction of computers and automation into industry. But those were very old and very basic insurance policies, and certainly did not address the myriad ways by which contemporary internet-based cyber threats now pose massive risks to markets. The second big jump happened in the 2000s, and this is for the slightly older folks in the crowd who still remember the Bug 2K of 2000. But the big threat at the time was the idea that planes will fall from the skies as we change dates from December 31st, 1999 to January 1st, 2000. And so people were buying Bug 2K, Y2K insurance policies that were supposed to cover them in the wake of that threat. But again, that also did not reflect contemporary kinds of cybersecurity malicious actors involved. And so really the kind of threats that we're talking about in a contemporaneous sense are these malicious actors hacking devices and engaging in data breaches. And those kinds of insurance policies came into the scene after 2003, when California introduced its first data breach notification law, and 50 other states in the United States all followed suit. And the reason for that is because data breach notification law, for the first time, put liabilities on CEOs of companies who were worried about the fact that they will have to pay a lot of money in creating data centers to notify consumers in the case of significant data breaches. And the more information became known publicly in newspapers and investigative reporting around hacking of commercial entities and private companies, the more CEOs realized that this was a real liability on the companies, and they turned to insurance as a model to cover those potential risks. And that is why the United States became the powerhouse for cyber insurance that it is today, is because it created the data breach notification frameworks, which set the scene towards increased acknowledgement and awareness on the part of CEOs of companies in this area. So what is cyber insurance? It's essentially an opportunity to cover two types of harms, both first-party harms and third-party harms. First-party harms are the harms that are associated with the particular victim. So those could be payments for ransomware in the case of a cyber ransom, cyber extortion attack. Those notification flows include costs, including credit and identity monitoring that I was talking about in the context of data breach notifications. But of course, more obviously, it's business interruption. So if you're not operating for 2 weeks, that's significant cost to you, reputational harms to you, you'll need litigation, PR services. All of this will be covered by your cyber insurer. The second part is the liability side. That's the third party coverage. And so that would be liability for you towards your consumers or your end users who might suffer their own business interruptions and losses because of your own hacking. And you can think about a massive hack like SolarWinds, one company's operating software causes significant harms down the supply chain. And so those parties can then come and bring liability suits against the service provider or solution provider. And so insurance in that case covers you for that liability, those litigation costs associated with the harm, as well as other related payments that you might pay in the cases of administrative fines or regulatory fines that you might suffer by a regulator as a result of your own hacking. And so the insurer, in order to cover you, wants to ensure that they can mitigate the risk. So they begin to offer you various kinds of services that would hopefully result in you being less likely to incur a harm. And so what insurers have started to provide are a set of services or riders, which would say, if you rely on our particular ex ante or ex post services, we will lower your premium or we will increase your cap, giving you a better insurance product in exchange for you relying on contractors that we work with that we trust in the area of cybersecurity. And so this might include compliance firms that will check you to see that you're compliant with, say, a cybersecurity standard or data protection standard, but it could be also cybersecurity firms who might come at the back end or at the front end to check the quality of your own cybersecurity practices and cybersecurity hygiene. So in that sense, insurers become kind of the first line of analysis of private actors' standard compliance with cybersecurity standards. And you see how that could play immense role in the context of threats like insider threat. And to what extent can we trust our insurers to do a good job in reducing the risks associated with insider threat would be the core of what I want to spend the second half of my presentation talking about. And really all of this is part of a broader theory that was first put forward by two professors, Omri Ben-Shahar and Kyle Lodge, who wrote an article back in 2013 now called Outsourcing Regulation, How Insurers Reduce Moral Hazard. And in that article, they essentially said that insurers are better at regulation than the government is. That for certain kinds of risks, insurers can do a better job than a top-down regulation that comes from a legislature. That they, because of the things that I've just mapped out, their knowledge and better possession of information about the risks and better connection with the private market are well positioned to engage in various kinds of incentive structures and market-based techniques to provide private ordering of particular kind of risks and to avoid the need of the regulator stepping in. And oftentimes the regulator, who has its own set of limitations, kind of feels like an elephant in a china house, kind of throwing around things that they probably shouldn't have. And so the insurers kind of are able to engage in more tailored, more nuanced, and more targeted interventions in the market that could potentially do a better job in regulation. And in this article, they give the example of fire insurance as one great example of where insurers have done a better job than what the government could. But the question is whether or not this also applies in cyber, and the extent to which insurers are really well positioned to replace the regulator in regulating this space. And so what I want to do in the limited time I have is just highlight a couple of the limitations that insurance companies have in actually meeting this, standard, to then show how that also manifests itself in the insider threat context. So the first thing that people like to talk about is the actuarial challenge associated with cyber insurance. That is the capacity of commercial insurers to actually model this risk. And part of the problem and why actuarial analysis is difficult in cyberspace is the fact that commercial insurers are perhaps not the best information gatherers in this space. That is to say, the commercial insurer might not have the same kind of access that other entities might have, both about security risks, security data, and about post-factum claims, what happens after the fact, after a harm has occurred. And so perhaps in those contexts, and in particular, as we think about state-sponsored cyber activity, it is perhaps the government who is better positioned to collect this information through its intelligence agencies and law enforcement arms, and not the commercial insurer who might not have the necessary information. It's also about the tools that insurers use. So the most common tool for actuarial analysis that insurers employ is a questionnaire. And I'm sure that if you've ever bought an insurance policy, you probably went online on the internet and had to fill a form online. And in that form, they probably ask you a couple questions about how you drive your car and how often do you drive it and what's your current mileage and whether you've brought any claims in the last 5 years. And something very simple and basic. And on the basis of this, they'll give you an offer for an automobile insurance policy. So to go up in scale, insurers in the cyber insurance context want to do the same exact thing, to try and turn cybersecurity into a questionnaire-based system that could allow it to offer its product to the largest pool of potential clients as it can. And the result might be that we translate basic cybersecurity standards into yes or no questions that don't neatly are able to capture the full scope of the risk and the full scope of behaviors that we would want to see implemented by a particular client. And it is in that sense that the insurer might not fully grasp the risk posed by a particular policyholder and therefore will be unable to price their product to the unique set of risks that policyholder introduces, thereby opening the door for the insurer to suffer increased claims and therefore risk of insolvency if a massive cyber attack occurs. And so various tools, and you see that on the bottom right of your screen, various tools have been proposed for engaging in automated machine learning AI-based cyber modeling, and those are trying to be offered now to provide a better cyber insurance solution, but we are still very much in the early days of these kind of report card-based analyses. And there's always also the question of how much information can you gather from open source-based analysis, which much of this is about, and even from pinging a network from in a remote sense without gaining full access into the networks in person. Which is, again, the common tools that are currently being used for these kinds of modeling techniques. So here's just one example. Here's a questionnaire from a top insurance company. I just want to highlight to you one question from this questionnaire to just demonstrate the absurdity of some of these questions. So here's a question: do you prominently disclose your privacy policy and do you always honor it? As if anyone can ever say no to this question, and as if answering yes actually tells you anything substantive about the privacy policies adopted by your client. The second problem I want to highlight in the context of cyber insurance has to do with information asymmetries and risk classification problems. So I already talked about why the insurer might not be the best positioned entity to gather information about this risk, but there's also questions of classification. The only way we engage in modeling in the cyber insurance space is by classifying different set of actors to different groups of risk, so to be able to diversify one's portfolio and map out grouping you into groups on the basis of which to price your product. But the problem is that cyber is one area in which our traditional classifications might not work. Say the classification between a big company and a small company. It's a common classification in the insurance context, but a big company might be a lower cybersecurity threat and a small company might be a huge cybersecurity threat. And the reason for that is because a big company might be a company with limited collection of data practices and limited information possessed by it, whereas a small company might have a large data set with significant personally identifiable information, posing a greater threat for data breaches and potential harms. And so how do we create classifications in cyberspace and evolve our traditional insurance frameworks is something that insurers still need to do. And one solution for that is that many of them rely on reinsurance companies, which are just insurance for insurance companies, who might have the better understanding of these markets. And so they engage in kind of profit sharing between the insurance company and the reinsurance company in exchange for the reinsurance company offering particular knowledge and expertise to the insurance company. And that's generally a positive thing. But the problem is that we then need to trust only a handful of reinsurance companies who are monopolizing this market. And the question becomes whether or not we can trust them to understand this fully, where we as regulators and legislators and cybersecurity professionals have not necessarily yet figured this out. And so we've entrusted them to do the big brother job of providing education to commercial insurers without yet licensing or setting standards for the reinsurance to necessarily adopt. The third, and perhaps one of almost the last problem I want to highlight, is the cyber aggregation problem. So cyber aggregation has to do with mega cybersecurity threats, which can also exist in the context of insider threats. These are threats that are the result of the unique features of our interoperable, interdependent internet. So the traditional view with insurance is that if there's a fire in one part of the country, it's not in the other part of the country. If there's an earthquake in one part of the country, it doesn't manifest itself in the same way in another. And so I can diversify my portfolio by offering insurance for earthquakes in one part of the country and for fires in another. And so those who don't suffer from fire will be paying off those who don't suffer from earthquake. But in the cybersecurity context, territorial borders and geographical zoning doesn't simply work. And so as you see in the bottom part of your screen in the context of the WannaCry ransomware attack, where a single incident resulted in more than 300,000 computers in 150 countries shutting down. And so our ability to segregate and ensure that harm does not manifest in a kind of mega catastrophe sort of way is limited by the fact that our internet is simply unterritorial. But it's also has to do with the fact that we all rely on the same services, right? There's only a handful of cloud service providers, only a handful of supply chain providers. And so a failure to patch across the industry results in one harm in, say, a Microsoft provider having echoing kind of ripple effects across the industry where we all collapse at once. And so the monopolies that are so common in the tech industry and our over-reliance on a handful of service providers, like in the case of SolarWinds as a prime example, could mean that one breach, one vulnerability results in a massive vulnerability where we all are the targets. And so how do we address aggregation problems is something that is still under significant challenge. The last thing I'll just mention, but an important one, is there's also lack of uniform language and standardization within these policies. So insurance policies are known, perhaps notoriously known, for having exclusions. That is cases in which we'll exclude your coverage for various reasons. And those exclusions use particular kind of language around cyber terrorism and cyber warfare as a one common topic, or around what is reasonable cybersecurity practices. A failure to meet certain reasonable cybersecurity practices would result in you not being covered. And so the fact that there is no uniform standardized understanding of what the language of the insurance policy is, what are triggering events, what are excluding events, result in less of predictability around the usefulness of this tool in the context of these markets. And so with that in mind, I want to kind of make sure that I leave enough time for us to talk about insider threat more specifically, given that this is the topic of this panel. And part of the problem in thinking about the relationship between insider threat and cyber insurance is the fact that insider threat is not a single type of threat. There's different kinds of insider threats, and each of them will have different kind of relationships with insurance. And so you see on the bottom of your screen 5 categories. I think that they are well encompassing of the kind of threats that I'm sure the other speakers will also be speaking about. But they include, among others, a disgruntled employee, just someone who just really doesn't like the company and wants to take action to reflect that, or a careless employee, a negligent employee, one that is just acting in a negligent way to ignore the rules of the organization's cybersecurity policy. Both of these examples are problematic from an insurance policy perspective because insurance doesn't tend to cover intentional acts. So traditionally, insurance doesn't cover voluntary acts taken by the policyholder or those agents working on its behalf. And yet, if so much of the insider threat problem is one posed by our very employees taking actions either intentionally or negligently, there's an ongoing question about what is the scope of coverage that we will get. Relatedly, social engineering attacks are advancing in scope and in sophistication. So to the point where there's now targeted attacks that are tailored to the unique features of the company, something like the email address will look exactly like that of the CEO of the company emailing you. It will be followed up by a phone call from the bank. Everything will sound exactly as if it is a legitimate transfer. And then the person from the accounting department will be asked to transfer X amount of money to a particular account. And they will only realize after the fact that they've been duped into engaging in a malicious activity. And so again, insurance will have to decide, are we covering these sorts of activities and in what ways? And what actions can we do beforehand in terms of training, in terms of introducing certain technological tools, various kinds of double checking and triple checking before actions are taking place, or moderating or lagging actual payments so that they can be reviewed by other entities. What can we mandate in order to mitigate that risk? And as everything I said until now, these solutions are still evolving. And there's, again, no uniform standard adopted by all commercial insurers. So we, as regulators, as legislators, might want to take a more aggressive role if we're worried about insider threat around ensuring that these commercial insurers are adopting a uniform standards on these issues, encouraging them to adopt certain expected behavior amongst their policyholders. The last thing I'll just mention is that on top of all of this is the specific concern of nation states and their involvement in these kinds of threats, and in particular in the context of inside agents, so say spies literally infiltrating your organization, but also in the context of them utilizing various tools that are so advanced that they would not be detected by traditional cybersecurity monitoring tools. And the idea of the nation state as a threat actor is one that is commonly excluded from traditional cyber insurance policies. They say that they do not cover activity conducted by a sovereign nation. And so here is where commercial entities would again be stuck between a rock and a hard place, because they cannot insure from this threat, and they cannot anticipate it in advance because it's the kind of threat that would be very hard to detect. So again, the government would have to step in. The government will need to provide the insurance coverage in order to ensure that its companies, that its industries are able to address these kind of threats once they materialize. But also will need to provide a sense of deterrence against these other nation states by saying, oh, you see, we will be there. So even if you attack us, we will provide our companies coverage. And so here's another reason why you might want to back off. And so we might see a federal or national insurance as a governmental tool in deterrence of particular cyber threats being introduced by foreign nations. But relatedly, we'll also need to define what is a sovereign nation threat, given that so much of these attacks are conducted by criminal organizations with loose ties to nation states, like Russia or China or North Korea. And so the very definition of attribution in cyberspace kind of materializes in a problematic way in the context of insider trade and cyber insurance. So that was a general overview, and I hope one that was useful in the context of our conversations today.
Yeah, so thank you very much, Asaf, for your lecture today. That was really helpful. Would it be fair to summarize your point by saying that the industry is basically on their own and they can't trust cybersecurity, at least for now, with regard to insider threat?
I'd say a couple of things. I think that we certainly are in a point where if you are a company and you're not thinking about these issues, you're committing a great dereliction of your basic duties to your customers. And perhaps there are even fiduciary duties or certain duties of care on the part of companies owed to their clients or to their users to take these into account. And a failure to do so could result in either piercing the veil and holding particular CEOs of companies liable for not meeting these basic standards. I certainly think that is where our regulatory environment is going. But I think your question is poking at something even harder. But how can we expect them to meet these standards if we don't know how to do it effectively? And I think that is a significant challenge. And I think one that governments are continuously dealing with and trying to formulate national frameworks that could provide companies a basic level of defense, and then expecting those companies to meet that standard. I think it is absolutely correct that it's impossible to expect them to meet a standard that has not yet been set. And so it's our duty to develop particular kind of expectations of behavior, what I called reasonable security measures that can be employed. And the reality is, unfortunately, is that in certain parts of our markets, we're just lagging behind on basic things like double factor authentication. So until some of our companies don't meet up the most basic of standards, I think there still is good reason to hold particular CEOs and boards of directors to account for not complying with those basic features. But you're right that the more complex threats on that kind of range that I was trying to depict it in the insider threat context, those are harder to hold them liable for. And we as governments, we as nations need to develop frameworks first.
So Asaf, another question for you. Let's talk about supply chain attacks, right? They are very popular nowadays. You mentioned SolarWind. So assuming that I'm a huge company, right? And I'm doing everything right. I check all the boxes and I'm doing everything right. But one of my suppliers, one of my vendors didn't do good enough and we are under attack.
So that's a real problem in the markets right now, and one that is perfectly demonstrated by SolarWinds. How much can you trust various entities along your supply chain? And so there's a couple of things that can be said here. One is that you do have power at the moment of contracting. And so what have you done as either a purchaser of a solution or a purchaser or a buyer of a solution, depending on, a buyer of a solution and one that is then providing certain solutions to others, to engage in risk liability sharing or risk transfer in the contracting stage. So one part is, have you tried to make clear that you will not be held liable in the context of the harm coming from elsewhere? And that's something that you need to be very explicit about when you're working with your own consumers and your own users. But relatedly, what kind of basic standards of review have you conducted on the companies you choose to work with? And now particular companies are giving greater latitude to request basic standards of, we want to make sure you're compliant with this or that before we contract with you. So we won't contract with anyone who's not GDPR compliant or who's not ISO compliant and so on and so forth. But we might also say that we want to engage in kind of once every 5 months testing how you basically protect our data or how you're handling our data. Or you might have to disclose to us certain data sets that can demonstrate how you've shared our data with others or so on and so forth, who access the data, stuff like that. So you can become more forceful and aggressive in ensuring protection and compliance with your fellow companies in your orbit. And a lot of companies don't do that. They don't have the resources, or they don't have the energy, or they don't understand necessarily the kind of threats that are posed to them from contracting. And so there too, insurers can play an increasing role, in part because insurance is there along the supply chain. One commercial insurer can be there to offer insurance for the cloud provider, and at the same time to offer it to the manufacturer of the chip and the shipment company, and then at the end of the day to the toy developer. And so because of that, they have a broader outlook along the supply chain and could, in the long haul, play a better role in understanding the ecosystem to be able to guide and advise their policyholders on these supply chain issues. But as you noted correctly, we're just not there yet.
Thank you, Asaf.